Brexit continues to haunt the UK in a deeply troubling way. 3 property investment funds there are now telling investors they cannot withdraw their money. Just take that in for a second. You're an investor and you're being told you cannot withdraw your money. Now, some analysts fear this could be the first tremors of another credit crunch.
Brexit and uncertainty, they're almost being used synonymously. And the Governor of the Bank of England seems to agree.
The UK has entered a period of uncertainty and significant economic adjustment.
There's one sector that's getting hit particularly hard by the Brexit confusion, and that's property. 3 property funds have now frozen their customers' assets. M&G Investments, Aviva and Standard Life are all preventing clients from making withdrawals. Why? Because customers have rushed to take money out of the funds, fearing the commercial property market could collapse in the wake of Brexit. So how much money are we talking about? Well, together the 3 funds in question have more than $11 billion worth of investments. The funds only carry between 7 and 13% of that value in cash at any one time. So it means a rush on withdrawals puts them under huge pressure. And if the fear spreads, more funds could be affected, which potentially puts $30 billion of investments at risk. There are echoes of the financial crisis that took hold of the UK back in 2007, when customers of the struggling bank Northern Rock were told they couldn't take out their money. The Bank of England has already relaxed banking rules to try to get more cash flowing in the economy.
3/4 of UK banks, accounting for 90% of the stock of UK lending, will immediately have greater flexibility to supply credit to UK households and firms.
But the big question is whether this will be enough to avoid a repeat of these kind of scenes. And as with almost everything surrounding Brexit, the answer is uncertain.
Now, we said some believe the UK could be seeing the first signs of a credit crunch, but our next guest says definitely not. Kallum Pickering is a senior economist at Berenberg Bank, and he joins us now live from London. So, Kallum, let's take a look at the symptoms of the disease. We have 3 big funds. They can't and won't pay out. Why is this not the same, then, as 2007, 2008?
OK, let's remember, today is a very different world from 2008. Real estate values, primarily in London, where these funds have majority have their investments, have been stretched. It was simply the trigger. What would be the trigger for the sell-off? Brexit is the trigger for this sell-off. Now, the fact that these funds have halted redemptions does suggest that investors are expecting prices to fall in corporate real estate in the UK, particularly in London. But this doesn't necessarily have large implications for the rest of the UK. The majority of this is equity-financed foreign investment. There's no real reason why it should say prevent a regular household or business from drawing cash or using regular lending facilities on a day-to-day basis. This is an issue which is entirely constrained within the corporate market.
Right, so regular people and other institutions which have invested in this fund, if they can't get their money out, there are not enough of them to make a significant impact on the real economy. Is that what you're saying?
That's precisely right. Of course, we will see lenders a little bit less willing to lend and borrowers a little bit less willing to borrow over the coming months. Of course, political uncertainty is high, but household fundamentals, business fundamentals are much stronger than they were in 2008. They have the cash surpluses to buffer a period where credit access may soften. But I think that this uncertainty will resolve within a matter of months. This is not an issue that is fundamentally economic or financial in nature, like 2008 was.
A lot of pressure on commercial properties. Now, we know that 75% of small businesses use their properties as collateral to borrow against. Now, if they see the price of those assets going down, that's going to affect them, isn't it?
That's precisely right, but remember, the value of commercial property is intrinsically linked to economic expectations. So what we're seeing right now is weakened demand because of uncertainty, but as soon as that uncertainty falls, those economic fundamentals should resume. And property prices should stable. So it's just a case of policymakers such as the Bank of England ensuring investors and households that fundamentals are strong and things will recover when uncertainty diminishes.
Now, you mentioned the Bank of England there. The governor is telling banks they can reduce their safety capital ratios. In other words, they can lend more. He seems to be a little worried about a liquidity crisis, potentially heading one off in this way.
I think what the Bank of England done is a very, very smart move. Remember, it was the supply side of credit markets in 2008 which caused the clogging up of the financial sector. This time, what the Bank of England has done, it's reduced the capital buffer to ensure that there will be enough credit into markets. That means that if someone has a job or someone's business is making profit, they should be able to get access to credit. This won't be a supply side problem. This is a very smart move.
OK, Callum, if what you're predicting is true, then that is some rare good news today. Thank you.